Welcome to a Bailiwick Express podcast. This is Business Perspective, where we discuss the most important stories making waves in Guernsey's business community. Whether it be multi-million pound acquisitions, liquidations, new financial institutions or changes in legislation, we'll have a new topic and interviewee every week. Thank you for joining us. Welcome, I'm Matthew Leach, and this week I'm speaking to Carey Olsen partner Tony Lane. Carey Olsen's corporate team is currently advising on the takeover of Hipgnosis Songs Funds Limited, a $1 billion deal that continues to make headlines in the Financial Times. Mr. Lane explains the takeover and talks about how these kinds of deals are becoming ever more common in Guernsey.
This involves a company that is publicly listed, so it means its shares are listed on a stock exchange. Could be anywhere in the world. We have Guernsey companies listed in various exchanges around the world, but mostly it's London. That's the most common exchange on which Guernsey companies are listed. And so their shares can be bought and sold on a daily basis on the exchange. And a takeover is when someone comes in and wants to try and buy the whole lot, so buy the whole company. And there are two ways in which that can be done. The sort of traditional route, and probably what most people think of when they think of a public takeover, is a general offer, which is when the buyer essentially announces and writes to all of the shareholders to say, I want to buy your shares for £1.12p for each share. And the shareholders each have a choice: do they accept that or do they not accept it? And in order to complete that deal, essentially they have to get the vast majority of shareholders to accept that price. There's a provision in the companies law here, which is the same as in the UK companies law, which is that if a bidder makes an offer like that and gets over 90% acceptances, so that's 90% of all shares, then they can squeeze out the remainder on the basis that there's probably going to be a small number of shareholders who simply don't open their envelopes or have moved and haven't told anyone they've moved and that sort of thing. So as long as the vast majority of shareholders accept it, then you can forcibly acquire the remainder. So that's the sort of traditional way of doing it. But these days, actually, most schemes are done using the alternative route, which is a scheme of arrangement. And that is in some ways more complex, but also adds a bit more certainty for the buyer because it's a court-approved process. So you actually have the company itself, the target company, writing to its shareholders to say, someone has made an offer to buy all of the shares at £1.12p per share. We're having a shareholder meeting. Can you approve that? If it's approved by shareholders, then it would go to court and would need to be sanctioned by the court. And that is preferred these days because it's seen as easier and a more certain way of achieving it. Because whereas with the general offer I mentioned, you've got to get to 90% of everyone to get acceptances. With the scheme, you have a meeting. Those who turn up, you need 75% of the votes at the meeting and a majority in number of those at the meeting approving it. And if you get that threshold through, then you can go to the next stage of going to the court. And of course, you may only have, often with public companies, you don't have that high a turnout at shareholder meetings. So you may only have, say, 40% of your shareholders turning up to the meeting or submitting votes for the meeting. So then you only need to get 75% of that 40% rather than 90% of everyone. And if you get through that stage, get shareholder approval, and if it's sanctioned by the court, then everybody's shares are forcibly acquired, whether they didn't open the envelope, whether they didn't turn up to the meeting, or if they did turn up to the meeting and vote against it, they still have their shares taken off them and they are given the consideration that's been offered. And that sounds very draconian, and it is, because it's basically a process written into law which allows people to have their shares taken away from them against their will. But it is, and that is why we have the court, the last stage, which is to go to court to explain to the court, this is what we've done. We properly sent out a notice to everyone. We complied with all of the requirements of the law. We complied with all the governance requirements of the company itself. All shareholders had an opportunity to attend the meeting and vote and have their say. We provided all shareholders with all of the information that they need in order to make an informed decision. Everything was done properly. There's no other reasons why this is detrimental to shareholders, and as long as it's been approved by a significant majority of those who did submit a vote, then the submission to the court would be there's no reason not to approve it. And if the court is satisfied, then they will approve it. And then as soon as it's approved by the court, then it's a done deal, and the buyer knows with a stroke of a pen, they've acquired all of the shares of the company. So there are a lot more hoops to jump through with that process, but it's more certain. It's sort of all or nothing. Either the whole thing falls over, or the buyer ends up owning the whole company.
These are quite big moves then from somebody to try to acquire a company this way. I mean,
Yes.
Why do people go down this route? Why does this happen, and how often does it happen?
Well, how often it happens is usually not very often. Normally, in normal times, we here in Guernsey would probably only see one or two takeovers a year. Sometimes we wouldn't see any at all. I think prior to this latest run of takeovers that we've seen, I would guess the last one was probably at least 2 years ago, if not 3.
Okay.
And yet, in the last 12 months, we at Carey Olsen have been dealing with, I think we're now dealing with our 8th scheme of arrangement in 12 months. So there's been a massive uptick in activity. The reasons for that is largely market driven. So it's no secret that equity capital markets all around the world, but certainly in London, are in the doldrums.
Yeah.
It's hard to raise capital. There's lack of liquidity, and as a result of which, shares are trading at a discount to the value of the company. So, and this is particularly acute for listed investment funds, of which Guernsey has many. So, listeners may not be aware, but actually the investment company sector on the London Stock Exchange is really represented by either English companies or Guernsey companies.
Okay.
And there's a large number of Guernsey investment companies listed in London, and one of the features of those investment companies is that being an investment fund or a company, they have a portfolio of underlying assets which are held for investment purposes, rather than being a trading business which owns and operates its own business. So their assets are relatively easily sort of split up and sold off, and you can realise them relatively easily, at least compared to a trading company. And often they will periodically be publishing the evaluation of those assets. So it's very easy to see what the overall value of the underlying assets is. And yet when you look at the trading prices of the shares on the stock exchange, you can see that these are trading at a significant discount to the value of the assets that the company holds. And that presents an opportunity, because someone could come in and say, well, actually, if the shares that are trading at a 40% discount to the value of the assets, if I come in and bid somewhere in the middle, then there's a reason for shareholders to sell. But if they do sell, I end up with assets that are worth more than what I paid for them. So there's an opportunity there for people to come in and buy the company. There's other factors, such as some of the deals we've seen are consolidations. So particularly in the real estate sector, there's a lot of subscale real estate funds on the London markets. So these are funds which were maybe launched a few years back, probably had hopes of growing, raising more capital and expanding, but maybe haven't expanded and grown their portfolio as much as they wanted. And now they're sitting there as an investment fund on the London Stock Exchange, maybe with a sort of total market cap of about 200 million, which isn't really huge in investment companies' terms. And investors think, well, it's a bit too small, therefore the costs of running it are a bit disproportionate to the size of the fund. And it makes sense, if you have two real estate funds with similar portfolios, put them two together and you end up with something that's more efficient for investors. And as well as the cost efficiencies, one of the other features that's been happening recently is actual investment managers themselves have been consolidating. And one of the sort of knock-on consequences of that is, as they become bigger themselves, when they're allocating their investments, they're starting to say, we can't look at anything that's less than half $500 million, for instance. So they are pressuring the small funds to consolidate it so that because they just can't invest in them at the size that they are. So we're seeing a couple of the deals that we've seen have been consolidation deals on that basis. So instead of someone buying a company for cash, the buyer would offer shares in itself. So it's two listed vehicles. The buyer offers the target company shareholders shares in the buyer, and so they just move from being shareholders in the target to being shareholders in the buyer. But then, of course, the buyer owns the target, so it's all consolidated together, and you become a shareholder of a larger entity, and hopefully everyone benefits. That's the idea. So
it's a very active moment in time.
Yeah.
Yeah. So does this mean there's a lot of movement? Is this quite a unique moment in time for these kinds of...
It is. Yes, I've certainly not seen this level of activity at any point in time. And as I say, there's a number of different factors all working together to mean that we are seeing a much increased level of activity, whether it be consolidations or what's called take privates or public to private. So that would be where a private investment manager comes in and pays cash for a listed investment company, thinking that they can work the assets a bit better and make more money out of the assets than is currently represented by the share price.
Okay, I mean, these kinds of things. Then, if you have like with these massive big funds or corporations or groups or whatever, you must have a lot of shareholders.
Yes.
It must get incredibly complicated and time consuming. How long does it take, and what kind of issues arise from these processes?
So probably most of these sorts of vehicles will have, at the lower end, you're probably talking about sort of 200-300 shareholders. At the higher end, it might be sort of 1,500 shareholders, and that's that side of things.
Separate people, separate entities.
Yeah, separate entities. So a lot of them will be institutional investors and sort of significant institutions that have got big stakes. Others will be smaller retail investors. There'll be other platforms like Hargreaves Lansdown and an AJ Bell and other platforms like that, through which there will be a lot of retail investors. So it's a combination of different types of investor. But yes, there will all be each of those people on the register would be a separate shareholder, and you have to. But the process of communicating with them is quite streamlined by virtue of the company being listed on the stock exchange, because the company will have a registrar who maintains the register of members. It'll have a well-oiled process of sending out notifications to shareholders, because it has to do that on an annual basis when it calls its AGM, for instance, or if it's doing anything else during the course of the year. So the printing and postage bills for sending these things out to shareholders are quite hefty. So people try and use electronic
They're still done by
communications.
letters.
Well, they increasingly it's sort of using email, where a shareholder has provided an email or putting the information on a website, and then rather than sending them a 200-page document about the deal, you'll put the document on the website and then send them a one-page letter to say,
right, okay,
this is where you will find the document, and giving them access to the website. So it is thankfully getting more efficient, but nonetheless, you still need to make individual contact with every shareholder.
So when it comes to voting, then how does that happen? Because you're talking lots of people.
Yes, yeah, exactly. So then,
because I'm picturing Succession in my head, where they sit around a big board table and there's like 10 of them.
Yeah,
this is not that.
This is much larger numbers of people involved. So in terms of the pack that would go to shareholders, whether that's as a printed hard copy or being on the website, there would be a proxy form that people would fill out to vote and then return, and that could either be returning by email, submitting their vote through a website portal, or traditional way of filling in the form manually and signing it and putting it in the post back. And then those are all collated, and as you can imagine, there's very sort of fevered process of monitoring those votes as they come in to try and work out whether the vote's going the right way and what the shareholder reaction is. And
very exciting when it's happening, I'm sure.
Yeah, although inevitably, by the time a deal is announced, the bidder wants to know. They'll never know absolutely that they'll get it through, but they want to get as much of an indication that they'll get it through as they can. So before the deal is announced to the public, the bidder will approach a handful of the biggest shareholders, the sort of the institutional shareholders that hold sizable chunks of the shares, and ask those to sign up to an irrevocable undertaking, so that if they're willing to agree to the deal, they will sign an undertaking to say, yes, when you announce this deal, we agree, we will vote in favour of it.
Okay.
And so they'll have a certain number of the votes in their pocket already, shareholders who've signed that. And the reason that institutions might sign that is because they know that the bidder needs a certain amount of comfort in order to make the offer at all. And if they don't commit or give any indication of intentions, then maybe the deal won't happen.
I suppose with an intent to take over, and you're including lots and lots of people, it must get quite contentious sometimes.
Yeah, they're interesting deals in that the early stages can be quite contentious, in that when the bid is being made and the initial terms are being thrashed out, then there's some legal complexities around that, and sort of the terms of exactly when the bidder can withdraw and when they're committed. That sort of does take a bit of negotiation, but once the deal is largely settled, in that the terms have been thrashed out, actually the process of then running it through, once you get to the stage of talking to shareholders and notifying them, the bidder and the company are really on the same side in that they both want the deal to work.
Yeah, okay.
That can change, however, in that so most of the time we're acting for the company, the target company, and then so really the people we are advising are the board of directors of that target company, and so they have an ongoing duty to try and get the best outcome for the shareholders. And so in the early stages they will be trying to negotiate the best deal, and then when they think that they've got to the point where it's the best deal that's going to be offered to them, they'll decide, is this something we can recommend to shareholders or not? And at that point, if the answer is yes, then that's when it will go public. After then, probably everyone is on the same track to try and get the deal done. But if another bidder pops up and makes a competing bid, then it starts getting interesting, and actually the board, they might get on very well with the bidder, but they can't have a preference for one bidder over another, other than purely as a result of the terms of the bid, because their duty is to the shareholders to make sure that they are getting the best outcome for shareholders, regardless of what they might have other reasons for preferring one bid over the other, but essentially they have to always be looking out for the shareholders and doing the best thing by the shareholders.
So that must be happening more often then, surely. If this is happening more often in general, are you coming across situations where you are having other bidders come into these kinds of deals?
Yeah, increasingly. In fact, I would say it may be a coincidence. It may just be a result of the particular circumstances of some of the deals that we've done. But it is noticeable that the three schemes of arrangement that we completed in the last half of last year all went through without a hitch, in that a single offer was made once. I mean, some of them the companies have been discussing potential sales to a number of bidders at the very early stages, but once a preferred bidder was clearly there making the best offer, then it was announced, it went to shareholders approved it went to court, it was sanctioned by the court, everything went through as you would expect. For some of the ones we've been working on this side of the new year, it's been a bit more complicated, and as I say, that may be just a natural consequence of those transactions, but it may also mean that shareholders are becoming a bit more circumspect, in that they're starting to realise that there are plenty of bidders out there, and they don't necessarily have to accept the first one, and it might not always be the best option. So one of the one of the deals we were working on, sale of a gold mining company that's got interests in Tanzania and Kenya, so that's Shanta Gold Limited, which
this is the one that's awaiting court sanction.
Yeah, so it's got its shareholder approval and it's awaiting sanction by the court, but that should hopefully, touching wood, go through as long as we've done everything as we should have done. But crucially, it's now got the shareholder approval. But that took a bit of time, because when the first offer was made, whilst the directors, having been properly advised by their financial advisor that this was a deal that could be recommended to shareholders, and they did therefore recommend it to the shareholders and put it to them and let the shareholders decide, it was clear that the shareholders were fairly lukewarm about the offer.
Right.
And so it took quite a while for the votes to start coming in. And as a result, there were then lots of discussions, and then eventually the bidder was persuaded to increase their bid, which was then enough to get enough shareholders over the line and
speed it up a bit faster.
I think it was necessary in order to get the shareholder support. It wasn't going to be there. The shareholders weren't jumping at it at all. But then once the increased bid came in, it was then very quickly approved by shareholders. And then another one, a property fund, Aberdeen Property Fund, which was proposing to consolidate with another property vehicle. And then in the end, they were considering a number of different options. At one point, another bidder popped up and was showing interest, but then they went away. There was a lot of other discussion around whether it was better for shareholders for actually the company just to wind itself up in a managed fashion,
right.
So selling its assets over a period of time and returning the capital to shareholders. And in the end, the shareholders, majority of number of those voting supported the takeover, but crucially, some of the bigger shareholders didn't, so it didn't get the number of votes required. So they swung it because of the number of votes they had through their shareholdings. So that was actually rejected by shareholders, and now that the company is undergoing a managed wind down process instead. So it is they're not always sure things even once they go public and start the process.
And you come in right at the very beginning.
Not at the very, very beginning. So probably at the early stages, when the board is just sort of talking to people who are showing an interest and whatever, they'll be taking advice from their UK counsel, because as a result of being listed in London, they will have UK lawyers engaged on a permanent basis to make sure they're doing everything they need to do to comply with the London listing rules and FCA requirements in London. And so they'll be talking to them about the early stages of the transaction, and also their financial advisors, to advise them on whether the terms being offered to them are terms that are whether it's a good offer and whether it's something that they can recommend to shareholders, or whether there's something more that they should be pushing for. And so that we tend not to get involved at that stage, but once a deal is largely agreed, then usually we will get involved. That's in terms of the commercial terms of the deal are largely agreed. Then we will get involved and will be involved in overseeing the process of seeing it through to completion. So with a scheme that is a lot of work, because as you can imagine, it's with it being a Guernsey court process.
Yeah.
And there's also, although the terms might be agreed at the early stage and at the time when it is announced, there's still a lot of documentation to be pulled together. You've still got to produce a lengthy document to go to all your shareholders, setting out a lot of information to let them assess the transaction, calling the shareholder meetings, going to court. There are actually 2 court hearings, so we need to oversee all of that, and those court hearings being when they're a Guernsey company that's being involved, which is when we would be called in. Those court hearings happen here in Guernsey at the Royal Court. So it's us effectively that are undertaking that process.
Because they'll need local expertise. Our law
Yeah.
is slightly different, surely, for these kinds of
Ex-
processes.
Exactly. So the law is slightly different here in relation to schemes compared to England. It's very, very similar, but there are a few nuances that are different, and the court process is very different. And of course, actually, and English lawyers don't have the right to come in and present in the court, in the royal court. So they need to involve us to undertake. Yeah, exactly.
And so these sound fascinating. I mean, the goings on of even the ones that get rejected or the ones that get completed. I mean, and these are companies that must have footholds all over the world and different conversations with loads of different people. I mean, how do you find the work? What personally is this? This must be quite fascinating, rewarding.
Yeah, no, it is. They're extremely rewarding and engaging transactions. So, I mean, just from the company's point of view, it's a significant transaction. These don't happen very often. It's totally transformative for the company. The transaction is trying to return capital to shareholders and get the best outcome for shareholders. So it's incredibly interesting because of that. You're also working with top-tier advisors, often in many jurisdictions. So one of the ones we were working on last year was had a listing in London, but also in Johannesburg. So there's advisors in multiple jurisdictions covering all that, and you get to work really hand in glove with top-tier lawyers in London, investment bankers in London. There's often a investor relations, a PR side of things, so you get different people feeding in their aspect of the advice and all sort of pulling together to guide the board through the process and dealing with the board. So and because of the intricate nature of the scheme of arrangement and the fact that it's with it being a Guernsey company and a Guernsey scheme before the Guernsey courts, our advice and input is absolutely integral, and so they are they're incredibly interesting transactions to get involved with. And then, as lawyers, we love staring at documents and picking out some fine details, and there's a lot of that. You have to get it absolutely right because you're going to be going to court. You have to get it right because you don't want a disgruntled shareholder being able to pick holes with the transaction and say that it doesn't work because of X, Y, and Z. But you also you don't want to give the court any reason to question the process or what was done. So the documentation has to be absolutely right. And then you're also applying a lot of judgment and expertise in that you're trying to preempt potential issues that the court might have, and then so anticipate questions the court might raise and then address them in advance. And so you're presenting an argument or a justification to the court as to why this question they might think of raising is not actually an issue, and presenting evidence to satisfy the court that there isn't an issue here. It's right for the court to be raising the question, but you've already got the answer ready.
Yeah.
And
okay.
so that aspect of it is not just a case of applying the black letter law or drafting the documents perfectly. You also need to anticipate potential pitfalls further down the line and anticipate what the judge might question or what they might raise.
And once the company has been taken over, once the deal has been done, is your job then over, or is there anything that can come beyond?
So largely, yes. So as much as they are interesting and fascinating transactions to be involved in, the negative aspect of it is that once the company has been bought out, then it now is owned 100% by someone else. It's a loss of the company from the London Stock Exchange. So it's a loss of a company for the jurisdiction and a loss of a client. So your role does stop when the transaction's completed. So that's the sort of the downside of it. But I mean, Guernsey's investment company sector, as I mentioned at the start, is huge. And
So it's not going to dwindle out.
no, not at all, not at all. And it's market driven. As I say, there's lots of factors in the market combining at the moment to drive these takeovers. But the pendulum at some point will swing back the other way. And ever the optimist, at some point, maybe not this year, but hopefully into next year, the market will start to swing back, and then people will be raising new capital, launching new funds.
Right.
For now, we're very much in a consolidation or public to private stage of the cycle.
And you're in the midst of one at the moment. I know you can't talk much about it, of
Mm-hmm.
course, because this is what triggered this interest in the first place.
Yep.
I mean, what can you tell us about this project, this deal that you're undertaking, the work that you're doing right now?
Yeah, so the latest one, which is being picked up by the financial press, it's the Financial Times and others, and also the industry press, is the Hipgnosis Songs Fund, and which was launched. It's not surprising it's caught the interest because it's quite a sexy asset class compared to, no offence to those working in the real estate investment, but a fund invested in commercial real estate in the UK isn't quite as interesting for the newspapers as a fund that owns the royalty rights to recognisable artists and invests in the royalty streams coming from music. So it's much more interesting purely for that sense. And so Hipgnosis was the first of these types of funds to launch it as a Guernsey fund, and then Roundhill Music launched a little while after that. Roundhill was bought out end of last year, and now it's Hipgnosis' turn. So they've been in the press for a while anyway, because I won't get into all the detail, but if listeners want to, if they're not already aware, can easily find the interesting track record of the company on the internet. But essentially shareholders weren't happy with the direction of travel that the manager was taking, that the company was being taken in, and the advice it was getting from its manager. So the shareholders expressed that in a vote at the end of last year, as a result of which there was a wholesale change of the board of directors, and those new directors, I think, have clearly done a great job and got the company into a position where people have been making bids for the company.
Right,
So
okay.
they've recommended one bid, which is by an outfit called Concord, who are actually also behind the people who bought the Roundhill Music Fund last year. And so that, as it stands at the moment, is the recommended bid by the board, but there's potential for a competing bid that's also been reported in the press. And as a result of that potential, the bidder Concord has just increased its bid to try and remain the front runner. So there may be some more twists and turns to be played out on this one. We don't know, but I'm sure, given the combination of factors, it's going to be continue to be one that the press report on.
Does that make your job different if it's a more public company? Or a more public deal, or one that generates more interest?
Not different in that I think the considerations for us are the same. All boards will want to know that they are being properly advised and that they're doing the right thing by their shareholders, and that the factors they're taking into account when considering these offers are the right ones, and that there's a documented paper trail, because even if it's not in the public eye in the sense of the media, even so, all of these companies will have institutional shareholders involved and some retail element of shareholders, and if they're not doing the right thing, then any different group of those shareholders could very easily become vocal or object. So that the advice to be given and to be sought by the directors is always the same. The answers vary, obviously, in the circumstances, but the issues to be addressed are all the same, regardless of whether it's in the public eye or not. It just makes it slightly more interesting when you know that the deal you're working on is is popping up every couple of days in the Financial Times.
I can imagine it is. So just to round out today, thank you very much for being here. It's been eye-opening for me, very interesting. Just looking forward then to the next 12 months, you say it's quite active at the moment.
Yeah.
You said, hopefully, potentially, it might come down a little bit or become a little...
Yeah, I think it'll change a little bit. I think the many of the factors driving the current rush of takeovers will continue for a while. So I would expect that we'll have a few more later on in the year. There may be an element of the fact that some of the low-hanging fruit has already been picked. So some of the companies are ripe for being taken private, or the obvious consolidation candidates have already done that. But I'm sure there are still plenty of opportunities there for people to conduct takeovers. So I would expect there'll be a few more this year. But I do think probably towards the end of this year and into next, maybe the market will start to swing back the other way. Interest rates play a certain part in it, and if they start to come down again, then actually investment companies start to be more appealing again than they have been in the most recent times. And there's been a recognition in the London markets that there are some regulatory terms in the sort of rules that apply that aren't particularly helping the sector, that are causing investment companies to be undervalued, and not so. There's one issue, for instance, by way of illustration, is investment companies have to disclose the costs that are paid to managers and advisors in a certain way, and private funds don't have to disclose it in the same way. Now, there's one feature of the way in which public funds have to, which means that actually the cost disclosure is not transparent, in that it's actually positively misleading, because they have to effectively double count some of the costs. So an institution that's looking to allocate its investments could be saying, well, I'd like to invest in this public fund, but its document tells me it's 13% cost, whereas this private fund has got a cost base of half that. So I can't really invest in the public fund because its cost base is too high. But in reality, it hasn't got a 13% cost base because there's double counting there. So that is just meaning that people simply cannot invest because it doesn't meet their investment criteria. And so that is going to be addressed, and then hopefully that'll be one of a number of things that starts to unlock the market. And I imagine that once a few people start to launch new vehicles, it'll suddenly open the floodgates and lots of people will suddenly jump. I mean, the markets are driven as much by sentiment as rational thought. So people are holding off raising new money because they don't think they'll get it away. But as soon as they see some people succeeding, then lots of people will pile in trying to do the same. So I imagine it'll come back quite quickly when it does start to come back. But I wouldn't expect that that'll be this year. But we'll always... but I'm certainly looking forward to the time when, as a Guernsey funds lawyer, that we're launching new funds rather than just dealing with takeovers of them.
Well, it changed your job a little bit, I suppose. These are new clients potentially on the horizon.
Yeah, no, exactly. I mean, it's equally fascinating and rewarding to be launching new funds and then starting them on the journey, as it is to sort of guide them through the takeover process at the end of that journey. So.
Fantastic. Yeah. Thank you so much for coming in today and giving us an insight into all of that.
No, pleasure.
You've been listening to a Bailiwick Express podcast. If you like what you heard, please share, like and subscribe so we at Bailiwick can continue to pull apart the stories that affect you, the listener. Thank you for joining us.